welcome to the special Diwali edition of the Global View with me, Tanvir Gill. Diwali is that time of the year where everybody reflects on the year gone by and lays down plans for a brighter future. And no matter where you are, which part of the world you live in, Diwali is full of fun and festivities for Indians across the world. My guest today on the show is an Indian who may reside in California, but his heart is set in India. And so he is celebrating Diwali with us all the way from across 7 seas. Mohnish Pabrai, founder of Pabrai Investment Funds, joins me from the US to help our viewers understand the right investment philosophies that can help them create long-term wealth by investing in equities. Mohnish, it's so great to have you on the show. Thanks very much for taking out the time. From the entire team at ET Now, we wish you and your family a very happy Diwali and a prosperous New Year.
Well, likewise, Tanvir, and great to be here. And I just wanted to just stress that one of the reasons why we light up our houses during Diwali is to serve as a beacon for Lakshmi to know where to go. And of course, one of the advantages I have in California is that mine is the only house that is lit up on the street. And so Lakshmi gives me undivided attention. And the other thing I learned from Bill Gates is, he has a saying, he says that even if you're a monopoly, you have to ask for the order. And so when we do our Lakshmi Puja and Aarti, it's the only day of the year when I turn religious, I make sure that I make a very direct appeal to Lakshmi, basically chappad phad ke dena. And so this year I am going to include all the ET Now viewers in those prayers to make sure everyone has a very prosperous year.
Okay, so then I'm hoping that you would help our viewers also make money chappad phad ke from this Diwali to the next. While interacting with you, Mohnish, I saw you sign off with a quote from Sir John Templeton saying, trouble is opportunity. In the markets today, which are at record highs world over, there seems to be little trouble on the horizon just as yet. How does then one look for opportunities to make money?
Well, you're right that there isn't a whole lot of trouble, at least that markets are concerned with. But that's a great quote by Sir John Templeton. And just a year ago, at around this time, we had demonetization, and it was a shock to the system. And one of the things that happened at this time last year was that all the Indian publicly traded real estate companies saw significant drops in their prices. And they dropped to the point that some of them went down to, in my estimation, something like a third or a fourth of liquidation value. When you were buying a business with very good prospects going forward for 25 cents. And it was a wonderful Diwali gift in 2016, but of course people didn't realize that or focus on it. Pabrai funds did focus on it, and we did quite well as a result. So even in fully priced or overpriced markets like we have right now, there are always individual businesses that are going through temporary hiccups. And as long as you can, identify the underlying causes and whether they're temporary or permanent, that can lead to some very good upside.
I want to start off with the first classic philosophy that has never failed you, which is the power of compounding, fluency of compounding, as you would call it. Now, the point is that, through different time horizons, whether one invested in the 1980s, 90s, early 2000s, or even in 2010, one can understand in hindsight how power of compounding has worked. But for viewers tuning in right now, trying to assess where the opportunity lies over the course of the next 10 years, give us how one can apply that thumb rule in today's market environment where market valuations seem elevated.
Yeah, so I think that's very important. I think getting fluency on compounding is the reason why Warren Buffett is a billionaire, And it's a reason why a number of people, even people in India like Ramdev Agarwal, have done so well. So just to spend a couple of minutes on the importance of fluency in compounding. So we have something known as the rule of 72. And the rule of 72 basically makes it very simple in your head to figure out how long it takes money to double at different rates of return. So for example, if I have a 10% rate of return, I can just do 72 divided by 10. It's approximately 7. The money will double in 7 years if you're compounding at 10%. If you're compounding at 15%, it's going to be about five years. If you're going to do about 25%, it's going to be about 3 years. So having this in your head in terms of how long it takes money to double at a particular rate of return is very fundamental. It's very important to be able to do it in your head and very quickly. And the second thing is it's all about the number of doubles. And that's where what Einstein says, compounding is the eighth wonder of the world, is when you start multiplying doubles with each other, you get some just amazing results. So for example, 55% of India is under the age of 30, which is awesome. One of the things that gives you is that, if you're a 20 something person who's just started working, if you graduated from IIT or something, you've got at least 50 years of productive earning capacity ahead of you, and probably 60 or 70 years of compounding. And it's really important to start early. So there are really three elements to becoming incredibly rich without doing a whole lot of work. So the first is, the amount of money that you save. That's very important. The second is the rate of return. And the third is the length of the runway. So we have control over 2 out of the 3 completely. We control the length of the runway and we control the amount we save. So if you take a person who just graduated from IIT or IIM and they're making, let's say, 10 lakhs or 15 lakhs a year, 1 lakh a month, and they're saving, let's say, 3 lakhs a year, if they are compounding at 15%, every 5 years the money is going to double. So if you take a 50-year horizon, going from the age of 22 to 72, it's 10 doubles, and 10 doubles is 2 to the power of 10, and 2 to the power of 10 is 1024. So you throw away the 24, it's 1,000 times the 3 lakhs that person saved at 22, and that is 30 crores. So that person at 72, just from the savings at the age of 22, has 30 crores. At 23, he saves another 30 crores, and he keeps going. So by the time he gets to about 70, he's got hundreds and hundreds of crores, which is incredible without having done.
No, Mohnish, but Mohnish, I want to interrupt you here because for those early investors who are starting off young, in their early 20s, they would be saying, listening to you, I don't want to wait that long. I don't want to wait till I can enjoy my money at the age of 70. I want to start early and I want to retire early. So, give them how this philosophy would work from a 30-year time perspective.
Yeah, so actually 30 years is also not a problem. It's 2 to the power of 6. 2 to the power of 6 is 64. I mean, you're going to have 64 times the 30 lakhs you saved at 22, and that's still a huge amount of money. So the important thing is to consistently save every month. That's very important. And the second is don't try to be a hero. Don't try to, buy the stock your cousin mentioned to you last night. Set up a kind of a systematic program where every month, no matter what the markets are doing, you put the money to work. And now in India, we have tremendous choices. We've got some really, really high quality firms where you can give the money to, for example, if I mentioned Ramdev Agarwal, Motilal Oswal is a wonderful mutual fund shop, and they only do equities, and all of Ramdev's money is in one of those mutual funds. I think it's a Focus 35 or something. And I would just, piggyback on what Ramdev is doing. So put the money in the same fund that he has, just do it every month with every paycheck, and put it on autopilot. and you're going to wake up after 10, 15, 20 years, 30 years, and you're going to be wealthier than all of your peers.
But Mohnish, in your own experience, if you could highlight some of your own investments where this rule of compounding has worked in the current market environment, the benchmarks you have followed in evaluating there being a value-driven opportunity in comparison to growth prospects of a business that have worked very well for you to make the decision to invest in that business. Help us with an example from your own portfolio.
Yeah, I can give you a couple of examples. One of them is not really a stock tip because it's moved up quite a bit, but a couple of years ago, I looked at a company called Rain Industries. It's actually based in Hyderabad, and someone had sent me actually very well-written report on the business. And basically, the thesis of Rain Industries was extremely simple. The price I was paying per share in 2015, which was around 30 or 35 rupees a share, is approximately equal to the earnings per share of the company in around 2018 or 2019. So, if I put in 35,000 rupees, for example, bought 1,000 shares, in 4 years, the company is going to be making 35,000 rupees on those shares every year. And so it effectively becomes a PE of 1. So it was a complete no-brainer. I mean, anytime you can get to investing in a business at 1 time's earnings, you don't have to think about it too much. So Rain, anyway, it has moved up 5 or 6 times since we invested, but still has a ways to go. So that was just an example of something that was extremely obvious. And that's one of the key tests I use before I make an investment is, can I explain the thesis to a 10-year-old without the 10-year-old losing their attention within a couple of minutes? And another example is, I mentioned the demonetization. So the high quality real estate developers in India, they've really had 3 or 4 things happen in the last few years. So first of all, in a place like Mumbai, they have systematized how slum redevelopment takes place and society redevelopment takes place. Those rules have been codified in a manner that was not as crystal clear for decades. So they've made it very easy and straightforward to do redevelopment. The second is that we had demonetization, which basically took away huge component of cash transactions. And with that, it took away a lot of players who were, dealing with a lot of, high amounts of black money and so on. And the third is we have GST, and GST forces you to be in the organized economy and forces you to pay the tax, because otherwise you don't get the benefit of input tax credits. And so when you take all 3 of these things together, you get what Charlie Munger calls Lollapalooza effects. 1 plus 1 is not 2, 1 plus 1 becomes 11. So when they cascade on each other, so what happened is that you could have looked at any number of real estate companies in India. I mean, we made investments in 3 of them, in Kolte Patil and Suntech and in Oberoi Realty. And basically, pretty much we could have thrown a dart at that sector and done well with it. And on top of that, when you looked at the valuations, it was relatively easy to figure out the valuations. These businesses got down in some cases to 1/4 of liquidation value. I mean, if you're buying a business at a significant discount to what you can liquidate it to, and on top of it, it has a great earnings engine and good management and all those other good things, how can you lose?
Right, but you mentioned real estate. Is real estate still a compelling story, you think?
Yeah, well, it was a very compelling story 12 months ago. It's too bad we didn't do the show a year ago. But I mean, they still have room to run. It's just not as compelling as it was a year ago.
You're next philosophy, Mohnish, has been about the margin of safety. Be unreasonable. And this is very important because a lot of the times, we get viewer queries asking us how I can mitigate my downside risk in an investment. And margin of safety is the answer most of the times. Not all of the times, but most of the times. So explain how this philosophy has always worked for you to safeguard your portfolio in volatile markets.
Yeah. Well, return of capital is way more important than return on capital. And so one of the things, margin of safety is a concept that was introduced by Warren Buffett's teacher, Benjamin Graham. And the idea is that you buy things at a significant discount to what their underlying value is, so that in the event that either bad things happen or you made some mistake in your calculations, you have some fallback so you don't lose money. So it's a very important concept. But there's also another aspect to margin of safety, which is very important. And that is that the greater the discount to intrinsic value that you are paying, you get two things. One is you get downside protection, and the second is you get upside. So for example, I mentioned to you some of the real estate companies were trading at 1/4 of liquidation value. So what that gave you, it gave you a huge margin of safety, because real estate prices would have to correct something like more than 50, 60%, 70% before you would lose money in these companies. That's the first thing. So a lot of protection against price erosion in the future. But the second is that if those prices don't correct, even if the company doesn't add much value, you'll quadruple your money because you bought at 1/4. I mean, if you buy a flat worth 50 lakhs for 15 lakhs, you're going to triple your money. And so I think the important thing with margin of safety is it gives you two things. It gives you downside protection, and it gives you upside, which gets built in because of the downside protection. So both are very important, and they basically are kind of tied into each other, and those are important things to keep in mind.
Mohnish, I have to ask you about the IPO market because there's so much activity happening there. Now, there are two camps that are approaching this market differently. One camp, of course, believes you go in for the high price names, the consumer companies which are coming to the bourses at elevated valuations, buy them for the listing pop and take your gains on day one. The second is, of course, more focused on the deep structural stories that are bringing about a change in the economy. For example, insurance, right? You've had a series of insurance paper come into the market from the general insurance side, from the life insurance side, and also, reinsurance as a business is picking up, where, of course, you have to keep your faith for the long haul. Tell our viewers what would be the best way to approach the IPO market.
Yeah, so there's a very simple rule of investing I follow, which is never ever invest in any IPOs. And it hasn't hurt me over the decades following that rule. And there's a number of reasons why that should be the mantra for most investors. So first of all, an IPO is a company selling shares into the market. The company controls the timing. The company controls the story. The company has a lot of control over many factors. And they're optimized to maximize the proceeds that the company is going to get. So if the IPO market is hot for consumer non-durables, you're going to see a lot of consumer non-durables come out at that time. And so one of the big advantages we have with equity investing and investing in the markets is that these are auction-driven entities. And auction-driven entities tend to, basically tend to give us pricing that goes to extremes. At times it gets very euphoric, and at times it gets very pessimistic. And as an investor, you can take advantage when things get pessimistic, and usually be a seller when things get euphoric. So, for example, I mentioned, the real estate firms at 1/4 of liquidation value. If I went to those promoters last year and I said to them, listen, I want to buy 25% of your company or 10% of your company or 1% of your company, would you sell it to me at a 20% premium to your current stock price? They would just laugh me out of their office and say, get lost. They wouldn't be willing to sell it to me at 5 times the price that the stock was trading at, because they know what it's worth and they know it's undervalued. So the beauty of the stock market is it allows me to buy those stakes without having those conversations with those promoters. And that's the only reason I was able to buy those stakes. So same thing with Rain Industries. In 2015, the company would not be willing to issue equity at those prices. They would have never issued equity at those prices, but they didn't need to. You could just buy it from unsuspecting adults in the market. So a simple rule to follow is do not buy what is being sold, especially what is being sold by promoters. So just completely sidestep the IPO market. And the second is, you mentioned insurance. Clearly, India has a number of areas, insurance, banking, asset management, and so on, that will grow a lot. They'll grow at multiples of GDP growth, and GDP growth itself will go through a lot. But the investing game is not so much about these macro themes. It's getting down to a specific business. So you have to identify businesses where management is not only honest, they're highly competent, and they're going to go for it. They're going to go for the growth. The second is you have to go for businesses where there are strong tailwinds and which are producing and gushing cash, producing a lot of cash. And when you get that combination at a good price, at a reasonable price, that's when you step in. And the rest of the time you do nothing. So the most important thing after getting fluency on compounding is to have patience. We will not find investments every day or every month or every year. I mean, if you talk to me right now, I can hardly find anything to buy in India. I mean, there's 5,000 companies traded in India. I can hardly find anything to buy, and that's not a tragedy. It's perfectly fine. There will come times in the future when we have plenty of opportunities, and the important thing is when those times show up, to have the will and the resources to act on it.
And so, Mohnish, if that's your rule number one, do not invest in IPOs. And rule number two is do not forget rule number one.
Yeah, that's right. Wipe out IPO from your vocabulary.
Oh, but as a Diwali gift, do leave our viewers with one prediction, Mohnish, before I speak to you next Diwali, over the course of the next 12 months. One prediction as a Diwali gift for our viewers.
Well, I would say that the real estate basket I mentioned to you, Colte, Suntec, and Oberoi, my bet would be they'd be materially higher a year from now than they are today.
It's been such a pleasure, Mohnish, to be talking to you. Thanks very much for taking out the time all the way from California. We really appreciate you joining us for our Diwali programming. And once again, a very happy Diwali to you and your family.
Same to you, Tanvir, and happy Diwali to you and all your viewers. Thank you.
It's been such a pleasure, Mohnish. Well, with that, we come to the end of this edition of The Global View with Mohnish Pabrai. Hope you enjoyed the show. From the entire team at ET Now, once again, here's wishing all our viewers a very happy Diwali and a prosperous New Year.